The broadcast is now starting. All attendees are in listen-only mode.
Welcome to our 2019 webinar series. Our 2019 monthly webinars will include client stories, your client stories, and how those stories can help you and your clients in this year and beyond. Each webinar will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. We'll do our best to answer them as they come in. Today's webinars will be recorded and will be posted on our website within a week in case you missed it. Today's presenter is constantly monitoring the insurance and financial services industry to ensure your clients are getting the most up-to-date recommendations. In 2013, he joined LLIS with a CFP and MBA and has been leading LLIS as president and CEO. Here's Mark Maurer.
Thank you, Claudia, and thank you everybody for tuning in today. And we have a lot of things we're going to cover today, so I'm going to jump right in. We talked about the webinar is going to be about riders on different insurance policies, and there's a lot of different things you can add to an insurance policy. Some we think have value, some, well, not so much. And so when we talk about things that maybe we're not going to talk about, riders that don't have a lot of, that we don't recommend often because they may have limited value to your clients, we're going to talk about some other things. And riders that we aren't going to talk about might be Winona Rider or Easy Rider. So, what aren't we going to cover? But let's jump right into riders we are going to talk about. So here we're going to talk about, these are the Black Riders. If anybody's a big Lord of the Rings fan, I am. So these are the Black Riders. Part of the Lord of the Rings. So we're going to talk about how they relate to term life insurance. It's kind of a stretch, but hey, I had fun with it. So here's Frodo. He's age 32. And you know what? He needs term life insurance. I guess, being a hobbit, a little dangerous. Needs some life insurance. And he met with his ye old fee-only financial planner, who also happened to be a hobbit. He said, you know what? You need some term life insurance. And originally, they just mentioned one term life insurance policy. You might go as far as to say it was one term to rule them all. And Frodo, excellent health, preferred plus rates, and ye old fee-only financial planner recommended $3 million of 30-year term coverage. So we looked at that and said that makes sense. He's got his income, he's 32, may need to work another 30 years or more, so all of those things make sense. Annual premium, $1,938. So right away, we're looking at the amount of coverage based on years of potential future income. 30-year term would get him potentially to retirement age. So all of this makes sense. But then we decided to talk about and look at term riders for Frodo. So by layering multiple term policies, what we do is we add multiple policies together to make the same amount of total coverage. So we can layer $1 million, three $1 million policies together. But what we do is we layer or ladder different term lengths. So when we combine them all, Frodo is going to have the $3 million in coverage for the initial period of time. But as time goes on, he's going to have earned his income. Maybe he found the gold there in the cavern, in Smaug's cavern. I know, that's Bilbo. If any of you know, forgive me on that. But I'm mixing my hobbits. But he finds the gold. He has his income. So as time goes on, he needs to work fewer years. He needs less income to replace, because he's closer to retirement. He needs less as time goes on than he does today when he's farthest away from retirement age. And what is he doing with his income? He's getting his income. He's paying down debt. He's saving for the little hobbit's college. So all of those things that right now is when you have the most income earning years ahead of you. So the need for life insurance is greatest. But as time goes on, you have income behind you, fewer years ahead of you. Maybe you don't need as much life insurance. And so when I looked at the pricing, it said Preferred Plus for Frodo, $1,938. What are some of the things that go into deciding how somebody's going to be a Preferred Plus, a Preferred, or Standard? What do insurance companies look at? And so we have lots of charts. We can email underwriters to find out on any of your clients, given their particulars, what's an estimated rate class going to be for clients? Well, one of the things insurance companies look at is build. Now, hobbits are not known for being svelte and exercising a lot, so they tend to be a little under tall, tend to have a few extra pounds on them. Insurance companies are looking at travel. Where are clients traveling? Are they going to places on the state travel warning list? So, for Frodo, Mordor, traveling to Mordor, that's a level 4 do not travel area. So, he's kind of got that going against him. And how about pipeweed use? So how do different insurance companies look at occasional tobacco, regular tobacco, cigars here and there, maybe even marijuana? So all of those things go into finding the right insurance company. And that's all stuff we do here when we get your client's information, when we get that initial sort of upload about what their height and weight is, what medications they're taking, and checking with all these different insurance companies to find out what's the best fit. Well, here again, for Frodo, one term to rule them all, $3 million, 30-year term policy, $1938 per year. Again, great. But does he really need $3 million in 29 years when he's got 1 year to retirement? Now, we know that incomes increase and things like that, so it may not be exactly proportional, may not need $100,000 in 30 years, but there's some layering, there's some leveling off there, I think. And so we can look at standalone policies. So what we might do is just say, what if we have 3 separate 30-year term policies? So we have a 15, a 20, and a 30. So we'd have the $3 million for the first 15 years, when the little hobbits are smallest, when he still has a mortgage on his hobbit house, he's got years of income ahead. But then in 15 years, that first $1 million policy is going to drop off because maybe one of the little hobbits can drive now. And then in 20 years, some of them might be in Hobbit college. So this idea is that as today, when he's the furthest from retirement, he has $3 million in life insurance. But as time goes on, the potential future income decreases. And the neat thing is then the premiums decrease as these layers drop off. So that's a standalone, 3 separate standalone policies. But in this case, we looked at a company, Banner Life, that will do term riders. So riders, get it? The black riders. All right. Just if you're not wild about my analogies here, there's about 4 or 5 more of them. So I had fun with it. So I hope everybody enjoys. So if we use the term riders, you notice that the 30-year term policy is exactly the same, but those riders are $60 less. So it actually saves them $120 per year by using term riders on top of the main policy as compared to 3 separate policies. So you're probably asking, what's the difference? Well, what happens is thank you for the votes of confidence from people who were chiming in. Thank you. So what ends up happening is that the longest term policy is going to have a policy factor. And so what is a policy factor? It's an annual fee that includes things like the annual billing, basically some cost for the policy that it doesn't matter if it's $1 million term policy or an $8 million term policy. Somebody, that annual premium, the billing costs the same no matter the size of the policy. So it's sort of a fixed fee for the policy. And so what the insurance company does is they attach that to the longest term policy because that's the one that we think is going to be around the longest. But then they waive that $60 fee on the shorter riders, which kind of makes sense when you think about it. You're not sending 3 different statements, you're sending or bills, you're sending one bill. It might have 3 layers, but you're sending one bill. So there's some lower costs there. It's waived on the shorter term riders. So when you have 3 layers, it saves $120 per year. There's $60 on the longest one, but for the other 2 times 60, it's $120. What if he'd needed $4 million of insurance and we did it 10, 15, 20, and 30? Well, then it's saving $180 a year compared to traditional 4 different standalone policies. So term riders can make a lot of sense because I really like the idea of layering terms, or the term layers, term riders, and then the term rider part actually even saves some costs there. And I think I forgot to mention, if anybody has any questions along the way, please type them into the little question box where everybody's giving me some really nice feedback. So thank you all very much. Okay, what's this? There's a bull rider. And so I'm only going to spend about 8 seconds talking about him. Anybody get, okay. Whew, tough room. So we're going to talk about disability insurance. If any of you have any clients who are bull riders or professional bull riders, please don't take this as an assumption that they can actually get disability coverage. As you're looking at this, probably not a good idea. But here's somebody who would really like to have disability coverage if we could get it. So that's why we're leading in with a bull rider when we start talking about the different riders on a disability policy. Oh, good question. So if the client chooses a standalone scenario, they could stop paying on any one of those 3 policies if no longer needed, correct? So the answer is yes. So if you had the 3 standalone term policies, could cancel any of those at any time. Good follow-up question was, but what about with the rider? With the riders, you could cancel the shorter ones, but you couldn't cancel the longest one. So again, the idea is as time goes on, maybe you're ahead of the curve on some of your earning, and maybe you cancel the 15-year one in year 13. But you wouldn't be able to go backwards and say, I want to cancel the 30 and keep the other ones there. So good question. All right, individual plans, and there's more coming in, and I'll see if I can get to them here in a little bit. Good questions, everybody. Individual plans for individual disability policies. So with a traditional disability policy, it says we're going to pay a monthly benefit if somebody becomes disabled. You're not able to do the material and substantial duties of your occupation, and you're not working. So that's a basic disability definition. A residual or partial rider takes it a step further. If you're able to do some of your income or some of your duties, not a total loss of income, it will pay some partial benefits. The COLA or cost of living rider says if you have a monthly benefit and you're on claim for more than a year, it's going to increase your payments in year 2, year 3, year 4, based on some different factors for as long as you're on claim. The catastrophic rider says it can pay an additional monthly benefit depending on how severe the disability is. If it's what they call catastrophic, loss of sight, loss of speech, loss of hearing, cognitive impairment, different triggers, so you can get an additional monthly benefit on top of the base disability benefit. Own occupation definition, and this is one that a lot of advisors really like. It says if you're unable to perform the material and substantial duties of your occupation, even if you're working in another job, you can still get full benefits as long as you can't do your occupation. So for a lot of us office-based people, that's probably a harder thing to do. If you're a surgeon, something happens with your hand, can't work, can't operate anymore, then it's much more probably clear cut that you can not operate on people anymore, but you can do lots of other things. So that own occupation definition becomes very valuable. And then the one I'm going to talk a little bit more about are the increase riders. So there's a couple different types. There's future increase options, called the benefit update sometimes, the automatic increase riders. So the way these work is that based on earnings, but not health underwriting or health questions, you may be able to increase disability benefits before you become disabled. So the first one, which I think is the easiest, is the automatic increase rider. So it's included on a disability policy when someone's in good health. So if the policy is going to have a lot of exclusions or someone maybe has some health issues initially, you aren't going to be able to get the potentially get some of these riders because you're increasing the risk to the insurance company and they aren't asking any health questions. So it's usually included when somebody's issued a policy with good health. So what happens is it's designed to help keep up with inflation. So as time goes on, you get these offers, no medical or financial questions, and usually for a period of time. Most companies, it's for the first 5 or 6 years that you'll get an offer to increase your monthly benefits. Usually your $4,000 monthly benefit might have an option to increase by $160 next year if it's the 4%, or $200 if it's 5% based on the CPIU, whatever it might be. And you get a letter that says, we'll increase your $4,000 of monthly benefit to $4,200, $4,400, whatever it might be. The premium increase for that is $2 a month. So we'll do that unless you opt out. And most people do this because most of us have increasing incomes. It's a nice, easy way to get some additional disability benefits without all of the application process. Because it's offered, and once you choose not to accept it, then it's normally removed. Sometimes you have to refuse it twice, sometimes maybe once. It just depends. But again, sort of, at some point, it's kind of like the emails we get for people trying to sell us different things. At some point, I'm going to say you're really not interested. So I followed up twice, called twice, and then we're going to stop because something that you just don't necessarily have interest in. So those are automatic. Those are nice. Those are easy. Those are simple. Then you have the future increase options. And so again, without health underwriting, these help for larger increases in income down the line. So hopefully everybody starts making more income later on as they get more established. So these help with not $160 a month of additional benefits, but $2,000 or $3,000 of monthly additional benefits. And again, it's issued on the policy when you're in good health. Again, if someone's not in great health or has lots of exclusions, these are probably not going to be included on the policy because it guarantees that you can buy more coverage without the insurance company getting any updated info. If they're already concerned about some health issues, they're not going to offer that again. So again, guarantees the ability to purchase additional coverage based on just financial justification. Automatic increases, those were, you don't have to show anything. It's just automatically going to be an extra 4% for a few years. These, there's going to be some financial underwriting to see, do you qualify for another $2,000 or $3,000 a month? And there's two primary types across different insurance companies. So one is what's called a stated dollar amount. You have a $4,000 monthly disability benefit that has a $3,000 per month or $3,000 FIO, future increase option, whatever that pool is called. It has a defined amount. It's an aggregate number, and so I'll show you what that means later. Costs something to have it. So it costs a little bit more to have it. Other FIOs, kind of like the automatic increase, usually don't cost anything. Costs you something to have this rider, but you're able to pick and choose the amount you want to purchase at regular intervals. Usually it's every year. And so you can decide which year you want to exercise it. You can also decide how much. So let's say in this case, I have a $3,000 monthly FIO rider. I might be eligible for $1,000 right now. I send in my tax returns. The insurance company might say, you're eligible for another $1,000. I can say, I just want $500. Great. I'm going to increase the premium. $500 is added onto my base policy, so now it's a $4,500 policy per month, and I have $2,500 left in my FIO pool. It's not $300,000 every time. It's eventually I could take $4,000 and increase it by $3,000 to $7,000. Once I've increased my monthly benefit to $7,000, I don't have any future increase options left. And most insurance companies have some sort of limitations on these. Usually after age 45, there's going to be a limit on how much of that pool you could exercise. Otherwise, everybody would get $10,000 of FIO and $2,000 of monthly benefit. And then as soon as I'm not in good health, I'm going to say, hey, give me all $10,000 of my monthly benefits. So it prevents against adverse exercises. So usually after age 45, if you have a $3,000 FIO that you've never touched, you can usually only exercise maybe a third of it in any given year. So eventually you could do it, but prevents from saying, just waiting until I'm, got a cold or my chest feels a little tight regularly and exercising all those increases. The other type has no stated dollar amount. Sometimes it's called a benefit update. So there's no cost to this one, and there's no cap. Could be $10,000, could be $15,000 if all of a sudden somebody starts making a whole lot more money. Doesn't cost anything to have it, but when it doesn't cost anything, we have a few more hoops to jump through. So the FIO, the first one we talked about, where I kind of get to pick and choose every year how much I want, it's going to cost something. This one doesn't cost anything, but has a few more strings. Every 3 years, usually offered on a 3-year interval, you have to send in the paperwork to apply for it. So even if I was making $100,000 when I got my policy and I'm making $100,000 now, maybe I'm making $99,000, I still have to fill out the paperwork if I want to keep this rider. Now, the insurance company might say, you're not eligible for any more, and that's fine, but it stays on the policy. If you don't apply or don't send any information, then I think after twice, it comes off the policy. And a few more strings, but it doesn't cost anything. Another string is that you have to accept half of what you're eligible for. Again, if the goal is to use it to make sure that your disability benefits are keeping up with your income, that makes sense. You'd say, yes, I need additional coverage because my income's a lot higher. But have to accept, so maybe I'm eligible for $2,000 this year. I have to get at least $1,000. If I say I don't want it at all, then again, rider comes off the policy. Again, to prevent against people not doing any of this and just waiting until they're sick and then trying to upgrade and increase the policy as much as possible. Good question. Do they look at your health every 3 years on these? And again, I thought I said it, but I must not have made it clear. All 3 of these increase options have no health questions. The automatic one is no health and no financial underwriting. So here the application is really only a financial one. So with either of these second ones, whether it's $3,000 or the no stated, you do an application that's financial. Is there financial justification that I can get additional coverage, but there's 0 health questions? So good question, because I talked about the application, probably didn't make it clear that that's not a health, there's not one health question on there. It just asks what the income is. All right, good questions. Next rider, Ghost Rider. I do not know much about this one, but I'm a big fan of Nicolas Cage. He's just really interesting to look at as the years go on. So, Ghost Rider apparently is the most supernatural superhero of all. I did not see this movie. I did not even know that this was a movie. But it ended up with some really cool graphics for me because we're going to talk about hybrid life policies. So what's a hybrid life policy? It's a life insurance policy that has a long-term care rider attached to it. See how I did that? Long-term care rider, Ghost Rider. I know. So these are life insurance policies that your clients can also use for long-term care benefits. But if they never need long-term care, there's still a life insurance death benefit. So there's two types of hybrid life long-term care policies. You have the traditional, which here is again like Nick Cage on just sort of a regular looking motorcycle. And then you have the supercharged, which we have the super awesome flamethrowery Ghost Rider motorcycle. So we're going to talk about both of these briefly, but let's talk about the traditional plan first. The traditional plan is much more like a life insurance policy. It's designed to maximize the death benefit. It's usually a stated dollar amount, usually a no-lapse guarantee universal life policy. And the long-term care rider is usually a fixed 2% of the death benefit. Some companies have a 4%. I think one has a 3%. But for the most part, it's a life insurance design policy that if you need care, you can draw down on that death benefit at 2% of the face amount per month for up to 50 months. So there's no inflation, there's not a lot of bells and whistles. It's fairly straightforward. But when we use a no-lapse guarantee universal life policy, yes, so question 2% per month. Yes, so you can draw down on the death benefit for long-term care at 2% of the face amount of the life insurance policy per month. If I said year, sorry about that. 2% per month for 50 months. So using a no-lapse guarantee universal life policy, have a guaranteed death benefit, guaranteed long-term care pool, we know exactly what it is per month, guaranteed premium. So it's fairly straightforward. So here's Terry. She's age 65, and she has 3 Prudential whole life policies. And actually worked on the options for Terry and her husband, and looked at all of their situation. The advisor said, well, they really have minimal life insurance need. Our concern now is long-term care. So what can we do with their existing policies, knowing they have minimal life insurance need? It would be great if we don't have to pay any premiums in retirement to pay for the care. So there's these cash values here. How do we repurpose them to provide them with some long-term care benefits? So the first thing I looked at was the traditional hybrid life policy. So Terry, age 65, preferred non-smoker, for a $65,000 1035 exchange. There are 3 different companies I ran quotes for. And you can see the death benefit is somewhere between $122,000 and $148,000. So we're going to concentrate on the American General policy. For just a 1035 exchange, so that's a cash value transfer of existing policies, it can guarantee a $148,000 death benefit. If she dies and never needs long-term care, her beneficiaries get $148,000. But if she needs long-term care, goes on claim, she can accelerate. So accelerate, another word for that is reduce the death benefit by $29.73 per month for 50 months. So, and it's an indemnity design policy. So once she satisfies the claims, she's going to get a check for $29.73 per month. So she gets a check for $29.73, passes away after 1 month. Then her beneficiaries get the remainder of the death benefit, $148,648 minus $29.73, which I'm not good enough with math in my head to do that. But you get the idea. Let's say she used 25 months of long-term care benefits, her benefit passes away, she would have gotten 50% of that 148 to her through the long-term care benefits, and then her beneficiaries get the other 50% of that 148. So we turn the $65,000 into $148,000 that either will go to somebody as life insurance, she can use as long-term care, or a combination of both. But it's that $148,000 pool is the same. So that was a traditional policy. Now if we go to the supercharged, what we're talking about here is supercharging the long-term care benefit portion. Because we're talking about hybrids, we're talking about, if we just wanted life insurance, we just look at life insurance. But we're talking about hybrid wanting long-term care benefits to it. So how do we redo that? You take those existing $65,000 of cash value and turn it into a bigger long-term care benefit. So here's 3 different supercharged hybrid policy designs. So what we did is we looked at 4 years of long-term care benefits, pretty similar to the 50 months of the other policy. But these benefits, these long-term care benefits, have a 3% compounding inflation rider. With the traditional, it's just a flat amount, $148,000 death benefit. I can use $29.73 per month, whether that's next year or in 20 years. With this policy, there's a few things you might see here. There's 2 of them have a 100% return of premium factor after the first 10 years. I think even Securian's might be 5 years. So for someone who's looking at the cash values and says, I don't like the idea of maybe those going away, which they might with the traditional policies, to keep the guarantees out to somebody's age 95 or 100, many times there's not much cash value in the later years. But these options say, 2 of these say, in 10 years, you could surrender and get your money back. The elimination period, 90 days to 0 days. Now notice the death benefit, much smaller. The design is much less of the life insurance. We're supercharging the long-term care benefits. So we can actually get $2,400 to $2,700 per month for 4 years, but with the 3% inflation rider. So if we look at the bottom 2, Nationwide and Securian, the long-term care pool in 20 years is $245,000. So with the traditional, it was $148,000 whether I need it for life insurance or long-term care. With this option, we're supercharging the long-term care benefits. In 20 years, when she's 85, now there's almost a $250,000 pool she can use for long-term care. If she never needs it for long-term care, somebody gets $66,000, $67,000 as death benefit, just slightly more than what she's paid in. But if she needs care, long-term care, which is what in this situation we're much more concerned about, then we're making a much larger pool than the traditional long-term care policy. So there's lots of different, if you saw the death benefits and the monthly benefits, the policies are all fairly similar. And so sometimes knowing the client and some parts about what they're like helps determine which one of those options might be best for them. Do they want, or can they easily self-fund that first 90 days? If that's not a big deal, well then, then that's not necessarily a deciding factor. Some people like the idea of, if I need care, I can start that one policy right away. Or maybe a client who has pretty good, a good income flow, but maybe not a lot of liquid assets or a lot of flexibility. The 0 elimination period option may be a good option, because then they can start receiving benefits from the policy right away. Some people like the idea of that cash value. And for these particular clients, that was one of the things that they sort of said. Here's from the email. While there's no present intention or present need to access the cash value, those were their words. But it's something that they wanted to continue to have and be able to see. Or just purely maximize the long-term care benefits. If Terry had other assets and other income, sources of income, and this was really just designed to be the most long-term care benefits, that's a design too. That's an option. So all of those just sort of go into the decision matrix as far as which of these policies is best. It's usually which one's the best fit for a client. None of them are going to, always win on every single factor. So now we're going to look at some cowboys. Johnny Cash, Clint Eastwood. Just wait for it. Yippee-yi-yo, yippee-yi-yay, Ghost Riders in the sky. So in case you didn't recognize what song that was, it was Ghost Riders in the Sky. But more riders, Ghost Riders in the Sky, Pale Rider. And you know what happens with cowboys? Sometimes they get older too. And again, what do we think about as we get a little bit older? We still think about long-term care. Thank you, everybody. Thank you. Remember to tip your waiters. All right. These cowboys are getting older, and you know what? They've accumulated quite a bit of gold along the way. Yes, I am having fun. Thank you. They've accumulated quite a bit of gold, and so this is the most entertaining insurance webinar I've ever attended. I'm not sure that the words entertaining and insurance webinar have ever been in the same sentence before, so thank you very much. Annuity with long-term care rider. These cowboys, they have some gold already built up. And with a traditional long-term care policy, you're looking at a regular annual premium. Sometimes clients may have existing annuities that we're trying to repurpose for other things, and one of the ways we can repurpose it is long-term care. The annuity with long-term care rider, I think, is great for health issues. It tends to have the least stringent underwriting of traditional long-term care policies, the hybrid life long-term care policies. And so sometimes clients with health issues where maybe they aren't eligible for a traditional long-term care or life with long-term care policy, they can get coverage through the annuity. Couples who want shared care, but one has insurability issues, kind of flows into that first one. With the annuity couple, you can have both parts of a couple on the annuity and both be eligible to receive long-term care benefits. So where a traditional policy, if one was not insurable, then you have just a single long-term care policy. This one, you can actually add one on who maybe isn't eligible for traditional long-term care. And here is the example I'm going to use, but this happens fairly frequently. Husband and wife have existing cash values or existing annuities. One tends to have more than the other, and usually tends to have a lot more than the other. If we did a 1035 exchange from life insurance policies to life insurance policies, then the rules are that the 1035's rules are that the owner and the insureds have to be the same. So if we do a 1035 exchange from one person's life insurance policies to a life with long-term care, only that person can receive long-term care benefits. But if we use the annuity, we can actually use one person's cash value to an annuity for that person, but then the spouse can be eligible to receive long-term care benefits. The spouse actually isn't part of the annuity, but they're what's called an eligible person to receive the long-term care benefits. So here's a good example. Here we have Johnny and June. No life insurance needs for income replacement, don't have any minor kids, but they're in the long-term care planning phase now. In retirement, looking at retirement, have these whole life policies. What do they need them for? They don't have a big insurance need, but they're looking at all of their planning, and a little long-term care planning is what they're needing. This is not uncommon. Johnny's got $149,000 of cash value. June, she's got one little policy, it's got less than $10,000 of cash value. If we were doing life-to-life exchanges, Johnny's going to have a giant policy, and then June, we're going to have to come up with extra premiums in order to get her some coverage, because there's not enough in her policy to get her a policy. So we looked at the hybrid annuity, doing a 1035 exchange of Johnny's $149,000 to a joint hybrid annuity. So there's 3 different designs, but I looked at the first 2. You can basically have where the first 30 months of the long-term care annuity, you're pretty much using up your own money. You're decreasing the cash values of there to pay for care over the first 30 months. Once that's depleted, then there's a 36-month long-term care extension. So sort of like with the traditional life policy, there's a death benefit, but if I use it for long-term care, well, I'm reducing my death benefit. Here, with the annuity, once I start using it, well, the first thing I use is my cash values. Once I've used up my cash values, now there's another 3 years of long-term care benefits, and now that's the insurance company's money. So here, put in $149,000. If they need care, they can actually get up to $328,000 to pay for care. But the first $149,000, basically their own money. Design 2, now we add a 72-month extension on top of that. So they'd use up the first $149,000 is their own money, and then they have another $350,000 of insurance company money that sticks on there at the end. Well, why wouldn't you do design 2? Well, just kind of makes sense, wouldn't you? Well, let's look at the 20 years out, because the larger the long-term care pool, the more internal costs there are for it. So 20 years out, looking at design 1, they have a little bit, about the same amount in long-term care pool, about the same amount of monthly benefit, and the cash value, it's almost exactly the same. Basically, the interest earnings on the policy covered the cost for that extra long-term care rider, that $180,000 long-term care extension. So some people really like that idea. They like that design. Put my money in, basically my money's just going to sit there and tread water. If I pass away and never need it, my kids get it, my spouse gets it. If I need long-term care, great, there's more than I can get more out of it than I put in. So that's appealing to a lot of people. If we look at design number 2 with the bigger extension, and in this case, because Johnny's so much older, his costs out 20 years when he's 91, actually everything's a little bit less than initially. The long-term care pool, the monthly benefit, a little bit less than what it was, but look at the cash surrender value, $134,000 instead of $149,000. If they were more even in age, it wouldn't, the long-term care benefits would be about the same as they were originally. But design 2, you're getting a larger long-term care pool, but you see that there are higher costs, the cash surrender value is decreased. So I think, again, just depending on the different client, they're going to decide what makes more sense. I understand it's going to cost me something for long-term care. I'd like a bigger pool of benefits, design 2. I'm pretty happy just seeing that my cash value really doesn't do anything. But if I need some long-term care, I understand there's more than I put in. That's design 1. So what was the advisor's recommendation? They were going to 1035 exchange his policies to the joint hybrid annuity, and then they were pretty much going to cash in her policy. I don't know, go on a cruise, do something fun with it. It was, you couldn't commingle them through 1035 exchange. So that was the general idea. Knight Rider, one of my favorite shows growing up. I think Knight Rider came on at 7 o'clock and the A-Team came on at 8 o'clock. Yes, I'm dating myself a little bit, but Knight Rider, David Hasselhoff. And again, David Hasselhoff, he looks a little different than he did back in the Knight Rider days. And you know what? Again, starting to think about long-term care a little bit. So what are some long-term care riders? Well, long-term care is going to pay for expenses if you are unable to perform 2 of the 6 activities of daily living or have a cognitive impairment. And so long-term care coverage is going to reimburse for expenses that you incur when you can't do those things. You can add an inflation rider so that if you start off with a $100 daily benefit, then my benefits are going to increase by a 3%, 4%, 5% compound every year to help keep up with inflation, because $100 will buy X amount of long-term care goods today, but in 20 years, if I still just have $100, it's going to buy a lot less of that basket of goods. You can add a waiver of elimination period for a home health care rider. So usually a long-term care policy has a 90-day elimination period where you're self-funding the cost of care if you need it. But you can add this rider that says, well, but if I need care in the home, I want a 0-day elimination period. I can start receiving benefits from the policy right away. We're going to take a look at that in just a second. And then the shared care rider is one of my favorite riders on a long-term care policy. Generally, we're only going to look at the inflation riders and then the shared care rider for a spouse. But what it does is it lets one spouse dip into the other spouse's pool of benefits, their long-term care benefit pool, if that first spouse uses up all of his or hers. So it adds some flexibility there when you start figuring out how much should each person have, and then we can share those benefits. Well, David Hasselhoff, he's married Haley. So he's 65 and Haley's 38. So starting to look at long-term care planning. She normally wouldn't be, but David's 65 and his family financial planner said, this is really something we should start looking at. He said, okay. So David and Haley, I love the comments. David and Haley, they live in Los Angeles. So in the LA area, according to the website that I look at, says that $300 is a daily median nursing home price. And so what we'd normally look at is what I call my 80% rule. So when these studies are done, they're covering all of the expenses for needing a nursing home, but they consider things like meals, which most people usually eat 3 meals a day. And so in that $300 a day, there's some expenses that are things that we need to cover, whether we're in an assisted living facility, in a nursing home, wherever it might be. So I use the 80% number to say, what's the additional costs of being in a care facility? If I take out food, if I take out some of my, I've got to have it no matter where I am, then let's look at 80% of that number. So $240 a day. We look at a 90-day elimination period. Hopefully, with Night Rider royalties and things like that, he can self-insure that first 90 days. 3-year benefit period with the shared care rider. 3% compound inflation rider. And then I looked at the cost for without and with the waiver of home health care. Adds over $1,000 a year to add that waiver of home health care. So to say, I'm going to pay an extra $1,000 a year. So if I need care in my home right away, I'm not going to, going to get a 0-day elimination period instead of 3 months. So I don't normally recommend the waiver of home health care because of that cost difference. So coming back to Haley and David, with the shared care rider, it's really neat. She has 36 months of benefits, he has 36 months of benefits. If he uses up all 36 of his, he can dip into her 36 months of benefits. So that's what the shared care rider does. But the other thing that the shared care rider does, which is really cool, is what if one of the spouses dies? And so we're going to, in this case, get rid of David. Sorry, David. What happens is her benefits have been increased by his unused benefits. I'm going to assume he used none of his long-term care policy. She has her 3 years, and his 3 years of benefits jumped onto her policy. So now it's a 72-month policy, 72 month of benefits. And his premiums that he was paying drop off. So she's only paying her portion of the premiums, but gets to keep all of his unused benefits. That's a really neat thing. And especially in a scenario like Haley and David, where she may be around a lot longer than David, and he may not need the long-term care policy, this is a real benefit to Haley here. So hopefully they're watching. Anybody know who this is? This is the last Ryder we're going to talk about. Yes, this is Ryder from the Paw Patrol. So Ryder is in charge of a bunch of dogs who, they don't really fight crime around Adventure Bay, but they solve problems that people have, and it's a Nick Jr. So, you know, their problems are usually pretty small, like, you know, somebody lost the jars of pickles or something like that. But Ryder's around to manage all these dogs. And so what does this lead me into? This is a show for kids. And so we're going to talk about life insurance riders that pertain to children. So there's two different types. We're going to talk about the child rider that's attached to a traditional term policy and guaranteed purchase option. And this is usually on a universal life, a whole life policy. So first, what's a child rider? Maybe on permanent policies, I think of it as being on term life insurance. And parents get a term policy and you add units. They're usually called units instead of amount. I'm not sure why. We buy units of $1,000 on top of the policy. And usually it's anywhere between 10 units to 25 units. Unit equals $1,000. So how does it work? Once you get your term policy, it automatically covers all children who are between 14 days and 17 years old at policy issue. So I get a term policy, my kids are 2 and 4. Automatically, and I did 10 units, $10,000. So I get a term policy, automatically my 2 kids are insured for $10,000 each. So even though I get the unit I get is $10,000, and it says that means there's $10,000 of death benefit on any children. If I have 8 kids, that means there's $10,000 each. If I have 1 child, $10,000 on 1 child. But I pay the same premium regardless of how many kids I have. And then there's some other parts to it. New births and adoptions are covered usually after 14 days old. And the coverage lasts to the earlier of each child's 25th birthday and the insured's age 65. My parents couldn't buy a term policy now and add me on as a child rider. Sorry, much past all of these ages. So there's some things here to say, well, it's really for, you know, children, kids. What happens when the kids turn 25 or the insured turns 65? Well, many times you can convert. There might be some converted options. You may be able to convert it to some permanent coverage. It just depends on each different company on what their options are at that point. So here's Captain Turbot. He drives around Adventure Bay. He's a fisherman. And what happens is, well, he looked at some life insurance for himself. And for a $500,000 20-year term policy, he was looking at preferred health rates of $430 a year. Okay, so he has some kids, and so what he wanted to do is look at some child riders. Well, the particular insurance company I looked at here has a $5,000 child rider minimum, and it was going to cost $25 per year for 5 units. That's $5,000. It's minimum. $50 for 10 units, or $10,000 per child. Can go all the way up to 25 units. So that'd be $125 a year for 25 units. So you can see kind of the premiums here. He can get $500,000 for $430 a year, or $125, which is what, about a third of that premium, for $25,000 on kids. So child riders aren't necessarily the most efficient life insurance plan out there, but it's fairly straightforward and fairly simple to do. Then if we go to a different type of policy, so that's a term policy that is on the parent's life where you add a child rider. This would be a purchase option on a permanent life insurance policy insuring the child. So a lot of people have $50,000 policies on their children, $100,000 policies. You'll have clients who show up and they're 38 and 39 and have a $5,000 life insurance policy their parents bought through who knows who when they turned one, and they'll ask you what to do with it. It's got $4,000 of cash value. Parents like the idea of this future insurability of children, and so you can do that with permanent life insurance policies. And with the permanent policies, by adding these guaranteed purchase option riders, you're protecting their future insurability because you're getting the life insurance on them now when there tends to be little underwriting. And then these guaranteed purchase options allow purchase of additional insurance later without medical underwriting. Kind of like the future increase options on the disability. The key is that there's no medical underwriting. No medical underwriting, I might have said financial. No medical underwriting on the disability increases, no medical underwriting with these guaranteed purchase options on permanent policies, universal life or whole life policies. So most insurance policies today, 30 years ago, may have had a $5,000 or $10,000 minimum on policies. A lot of insurance companies are looking at a $50,000 minimum today on whole life policies, universal life policies, even on children. So how does a GPO, the guaranteed purchase option rider, work? Purchase additional coverage, no medical underwriting. There's usually a cap, and so many times it's 1%, 1 times the original face amount. So if it's a $50,000 whole life policy on a 4-year-old, at the specified times at age 22, 25, 28, 31, 34, 37, 40, 43, and 46, they can purchase an additional $50,000 each time. So that's 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 times 50, I can do that math in my head, 450. So potentially could have turned their $50,000 policy into a $500,000 whole life policy by the time they're in their mid-40s. No medical underwriting. That's the key. That's what makes this interesting. That's what makes this attractive, is no medical underwriting. Because not everybody makes the best choices when they're 18 or 19. And having that guaranteed insurability rider can be a good thing. Sometimes then there's also these alternate option dates, which include marriage, childbirth, adoption of children. And so what happens then if I get married at age 27, I exercise my increase at age 27, nothing happens. I used up the one that would have normally happened at age 28. So my next one is going to be age 31. So another just different rider on life insurance policies that particularly pertain to children. Even older people can add these riders on, but of course, the older you are, the fewer options you'd have eligible between your age and age 46. So it's most attractive, most often used when we're talking about children who have that sort of long time frame, long time horizon between now and when they might need to increase the coverage. And the good news is we are almost out of time, and I just happen to be at my last slide. So thank you everybody for tuning in today's webinar. For those of you who aren't familiar with LLIS, there's a number of things that we do for advisors, for fee-only advisors every year. Number one is these monthly webinars. So they're CFP-CE credits. In November, Jill is going to talk more about long-term care. It's Long-Term Care Awareness Month. And December, I'm going to be back for insurance planning for the new year. And hopefully I can make it as entertaining as this one. Thank you so much, everybody. What do we do? Well, we're not your competition. We don't do financial planning. We help you with the insurance component of your client's financial plan. We only work with fee-only advisors. We do a lot to save time for you and your client's money. A big part of that is the pre-underwriting, where I talked about Frodo. What's his height and weight? How often is he smoking the pipe weed? Where is he traveling? Is he going to Mordor more than once? Is he going regularly? So a lot of pre-underwriting that we do to avoid surprises and get all that, try to find the best fit for each client, because not every client's going to be the same. Number of advisor tools and client tools on our website. We're proud sponsors of a number of different fee-only financial planning organizations, have been for years, and every year that goes by, I'm just thrilled to keep working with everybody. We have specialists here in our office in life insurance, disability insurance, long-term care, annuities, the hybrid policies like we talked about. And we have 4 people in our policyholder service team, which sometimes when I talk to insurance companies, I'm not sure they have 4 people in their policyholder service team. And so we have 4 people here who help you and your clients, whether it's I've missed a premium, I got a lapse notice, I need to change my beneficiary, people who can help you and your clients with existing policies. And some of the emails and notices that we send out, like the advanced premium email or our notification of term expiration. We have our website so advisors can have access to an online portal. One other thing is that we're just about to set the dates for our 2020 LLIS Insurance Academy. It'll be here in sunny Florida. Hope it's sunny. Is it going to be sunny and warm? Not sure. It will probably be sunny and more warm than where many of you come from. So there's that. It'll be the end of February. It's 2 days of long-term life insurance, long-term care, disability. We're going to have 3 guest speakers for underwriters and long-term care claims people. So that'll be up on the website soon. Hope all of you, maybe not all of you, hope many of you can join us. Questions? I will answer as many of these as I can. Some are a little more detailed, and so if I don't get to them right now, I will email people individually. How do hybrids compare to, it looks like compare to traditional whole life policies, and will they increase as pure long-term cares have in the past few years? So the second part first is that the hybrid life policies are built on a guaranteed universal life chassis. So all of the benefits are guaranteed. So whether you have a single premium, a 10-pay, what have you, all of the costs of the expenses are guaranteed. So there won't be any increases like with traditional long-term care policies. So there's that. How much more do they cost beyond a traditional whole life policy? That's a good question. I'm not sure I've ever compared apples to apples there. Remember my illustration where we had the $65,000 and the death benefit was maybe 67 or 68. If we were just looking at a $68,000 whole life policy, it wouldn't take as much premium. So if we were looking at pure life insurance, we may look at a different type of policy. But the benefit is in that case not necessarily the death benefit, but the fact that the long-term care pool grew to almost $250,000. So it's a little bit of trying to compare apples to oranges, but hopefully that helped. All right, everybody, I'm over my time. Thank you all so much. Again, if there were questions or things, comments I didn't get a chance to address, I will address over the next couple of days. Yes, I agree. Winona Ryder was very cool in the 80s. Heather's a good movie. Also, Edward Scissorhands, Beetlejuice. So you can see where I did all my research. All right, thank you, everybody. Have a great October, and look forward to doing it again in December. Thanks.